Let's talk about the rate story and why some people don't believe in this rotation into the financials. It's because they listen to Federal Reserve officials, and those Fed officials tell them rates aren't going up for a long, long time. Therefore, why do I want to own the banks, Gerard? What do you say back?
I think one of the things we have to look at, John, is I think you pointed out year to date, the stocks are still down 30%. So we're nowhere near the levels we were at the end of 2019. So there's still real value here, even though the rate environment is not as positive for the banks as we'd like to see. I would point out, however, the yield curve has steepened a bit. So that's always positive for the bank's net interest margin. But a low rate environment that we're in today, and like you said, the Fed has indicated it's going to stay this way, that is one of the challenges the banks have. But what we're seeing, John, to offset that is the balance sheets are growing for the banks, which is very different than what we saw in 08-09. This growth in the balance sheets will offset the pressure on the margins due to the fact that more people are borrowing, not just through PPP, but also through the commercial lines of credit that the banks are issuing to their corporate customers.
Well, Gerard, you know better than most, that's a double-edged sword. They're extending their balance sheet in a really tough time, in a weak economy. I just wonder how much risk they're taking on at the moment, Gerard.
That's an interesting question because we certainly are seeing a very weak economy, and generally speaking, I think the consensus call, and certainly our call, is that the economy will recover in the second half of the year. Should that play out, then the credit risks are not as high as they may appear at this time. But if we stay in an extended recession into 21, then I'm with you, John, then there's going to be greater credit losses from these loans that are being put on the books. But right now, we don't see that at this time.
About some of the response that we might see from the Federal Reserve. We've been talking about yield curve control. The bond markets are pricing in negative rates. What would it do to U.S. banks if the Federal Reserve were to take rates below zero?
That would be really bad. We've seen this happen over in Japan and in Europe, and we've seen the pressure on the bank's profitability with negative rates. So negative rates would be one of the worst environments for the American banks. We don't see that happening just yet, though, as you point out, and I agree with you, Lisa, that there is futures calling for negative rates. But one of the enormous differences in this country than other parts of the world is our money market mutual fund industry. It's over $4.5 trillion in deposits here. And if we go negative rates, you're going to break the buck in many cases in that industry. And we know that is not acceptable for the money market mutual funds. And they are critical to the plumbing of the banking system and the financial system in the U.S. So I still don't think the Fed's going to take rates negative because of the money market mutual fund industry's importance to the financial system here in the U.S.